Welcome to the Unit 3 overview. Previously, this unit was written to the old standard IAS 18. The new standard IFRS 15 is mandatory for reporting dates commencing 1 January 2018. This means the first year ends affected are 31 December 2018 and then later on 31 March 2019 and 30 June 2019. There's kind of no time to be complacent though, because IT system changes, contract changes, and possible changes to the way products are offered will begin a year earlier, with entities needing to capture data for comparatives in financial reporting. So let's have a look at the standard. The revenue model under IFRS 15 has 5 steps. While it looks simple at first glance, within each step there are a number of complicating factors and more detailed principles. So the aim of this video is just to give you a brief summary. Let's go through step by step now. So first step is identify a contract with a customer. The next step is to identify the performance obligations. The third step is to determine the transaction price. The fourth step is allocate the transaction price to each of those performance obligations we identified in step 2. Lastly, we recognise revenue when that performance obligation is satisfied. So looking at step 1, identify the contract with a customer. IFRS 15 section 9 sets out our basics. The other question we need to ask here is, do we need to combine contracts? So this might call on some of your related parties knowledge from Unit 2. Moving on to step 2 then, identify the performance obligations. So here we need to think through the paragraphs that help us to decide whether a performance obligation to deliver a good or service is actually distinct. In the unit, we have flowcharts to help us walk through these requirements of IFRS 15. So the other thing to consider here is, how do we treat admin tasks? And we need to have a think about that and make sure we understand what's required in this area. The flowchart looks like this, and your notes in the CSG go through it in detail. So we need to ask a number of questions when we're looking at whether a performance obligation is distinct. So we need to consider whether the customer can benefit from the good or service on its own, what level of integrating different goods or services we offer under the contract, what modification of other goods or services occur under the contract, and whether the goods or services are actually highly interrelated or independent. Sometimes in an exam question, these issues around performance obligations might be spelled out for you. In other exam questions, you might need to apply this flowchart or the paragraphs of the standard to determine the performance obligations under the contract. In step 3, we need to determine the transaction price. The key objective in determining the transaction price is to determine the amount of consideration the entity expects to be entitled to. Sometimes in this step it's easy to get bogged down in the details. If you find this, keep coming back to this core principle. How much consideration are we expecting? Consideration sometimes only includes fixed consideration. Sometimes it only includes variable consideration, but many contracts with customers will actually include both. So sometimes you might ask yourself as you're going through this unit, is step 3 where all the work is? And that can be the case. As we can see, even just in this step, there's a number of factors to tick off. It's important to tick off all of these elements in determining the transaction price. Today, we're just going to focus on a few. There are 2 methods for estimating variable consideration, and we need to remember that variable consideration comes in a number of forms. Expected values are generally used when there's a yes or no element to the variable consideration. We either get it or we don't. An example of this is a performance bonus if we meet a particular delivery date. The most likely amount, on the other hand, is used when there are a number of probable outcomes. But always with variable consideration, we actually need to stop and really make sure we're not going to need to do a U-turn later on. The constraint paragraphs ask us to double check before recognising variable consideration. They ask, are you sure you're not going to need to back this revenue out later on? Are you really, really sure of no U-turns? And the wording in the standard says, is it highly probable a significant revenue reversal will not occur? This is actually a really nasty paragraph, so make sure you watch our dedicated video to tease it out entirely. The revenue model under IFRS 15 asks us to determine the transaction price, and one of the other elements is the existence of a significant financing component. Just look out for it in a question where there is a payment occurring greater than 12 months after the contract date. The basic steps here are to discount the amount that you're going to receive in the future to its present value, or to think about what cash consideration you would receive if you got it today. The interest income that is determined when there is a significant financing component needs to be shown separately in the statement of profit and loss and other comprehensive income. You might need to revisit this knowledge once you've covered Unit 9, which helps you understand the effective interest method for recognising that interest revenue. Step 4 of our 5-step model asks us to allocate the transaction price. So this is all about allocation, and it's all about allocating that price across the different performance obligations. Now, the basic version, the golden rule here is it should be relative to the standalone selling price if these are observable. We only go to other possible estimates if we can't observe that standalone selling price. There's always some exceptions. And sometimes we might also allocate variable consideration or discounts to a single performance obligation rather than to every single one. But start with the golden rule. The first example in the start of Unit 3 gives you a straightforward look at how this basic allocation works. In deciding when to recognise revenue, it is simply put, recognised when we satisfy that performance obligation. Now, what we need to know in this step is that some performance obligations are met over time and some performance obligations are met at a point in time. A good example of overtime is a service offered for a period of time. A good example of a point in time is where we have a sale of goods and control is passing to the customer on delivery. The different types of performance obligations have different patterns of revenue recognition, so these decisions directly affect your bottom line in a given period. When a performance obligation is done over time, ways of recognising revenue might include surveys of work done, the time lapsed in the contract, or the percentage completion. We choose a method that depicts the entity's performance. When performance obligations are met at a point in time, we recognise the revenue when control of the asset has been transferred to the customer, and the standard gives us some guidance around what that means. We hope you found this a useful overview to get you started in Unit 3 on revenue from contracts with customers. There are lots of embedded examples to help your understanding and activities and worked examples to work through with a deeper picture. As it is a new unit, we are very interested in your feedback on how helpful you find these learning materials. Good luck!